In this video, I am going to be sharing with you the 5 stocks that I've traded options on that have cumulatively generated me 6 figures in profits. And I'm not only going to be sharing with you what the stocks are, but I'm also going to be sharing with you what are the suitable option strategies that you should be trading on these stocks as a beginner. Now, before I get into this list, I want to first share with you what you will not find in this list. So you will not find any of those high implied volatility stocks inside here, right? So maybe those 100% or 200% implied volatility stocks, which are mostly the meme stocks, for example, like AMC or maybe even GME and so on and so forth. In fact, if you are just starting out trading options, you should be avoiding those stocks like the plague. So if you shouldn't be trading these stocks, then what stocks should you be trading? If you're ready, let's dive right into the very first one, and that is none other than SPY. So technically, SPY is not a stock, it is a basket of stock, which is the index ETF. In fact, I will even go further to say that, if you have not been consistently getting, good results so far in your trading, then you might want to consider trading just SPY alone, because if you trade it the right way with the right mechanics, you can become consistently profitable. So before I get into the option strategies, I want to first talk about why you want to trade SPY. So the very first reason is that this is a positive drift vehicle. What do I mean by positive drift? Positive drift just means that the underlying just wants to go up over the long term. And this is true for the broad-based index ETF. So in this case, SPY. As you can see over here, SPY has actually gone through quite a number of market crashes, right? It has been incepted for quite a number of years already. You can see over here in 2000, there's this dot-com bubble where the market came down. And then again in 2008, the great financial crisis, market came down. And then even in 2020, there's the pandemic, market came down. And then in 2022, there's the bear market and still many more other events during these years that would have caused a down movement in the underlying. But in the long term, you notice that it just kept making new highs. So why is this important? Because if you know the bias is towards the upside, then you can position your strategies to capture, this biasness to the upside. Now, the second reason, and a very important one as well, is that the studies have shown that the RM is less than EM. Now you might be wondering, Davis, what is RM less than EM? Are you saying that my relationship manager is less than my elderly mother? What? No. What I'm talking about is that the realized move is less than the expected move. And in fact, I've got a whole video just to talk about this. Basically, this is our edge in options. So let me show you what I mean over here. So as you can see, this is a table, a research done by the Tasty Trade team, where they measured the actual movement in the market, which is the average realized move, versus the theoretical movement. So this is the move, or rather the range of movement that's calculated out, basically trying to predict what is the actual move in the market. But as you can see over here, there's some discrepancy. So the average expected move based on theory, the calculation, is always more than the average realized move over a period of time. So as you can see, even depending on the different volatility levels, you can see that the average expected move is always more than the average realized move. You can see over here, when volatility is low, average expected move more than the average realized move. And when the volatility is very high, same thing as well. And in fact, this edge that we have down here, RM less than EM, is much more pronounced in the index ETF than the individual stocks. And these are the studies that have already been done by the Tasty Trade team as well. So that is why we also want to trade SPY because of this. So if you're not very familiar about this whole concept, I would suggest that you familiarize yourself with it because it is very important and it's our edge when we're trading options. So I've already created a whole video regarding this, and the title is the #1 secret to becoming consistently profitable trading options. So just head on to my channel and look for this video. Now, the final reason why we want to trade SPY is because the Tasty Trade team, they have already tested multiple option strategies on SPY and they have been proven profitable. So as you can see over here, this is the short put. The short put on the SPY over the long term is going to be profitable. As you can see, this study is across a few years, right? You can see it's from 2006 all the way past pandemic. So that's more than a decade. So this study down here is pretty statistically significant. So one thing you'll notice is that you do have losing years, and this is normal, guys. You cannot find a strategy that's going to be profitable every single year. Right, so as you can see over here, in 2008, when there's the financial crisis, the short put will be losing money. But again, over the long term, after that, when the market recovers, the strategy recovers as well. Now, next is the put spread. And as you can see, same thing as well. Regardless whether you are managing it at 21 DTE or holding the trade all rate to expiration, you're going to be net profitable over the long term. Next is the fancy smanchy strangle. So this is something that the Tasty Trade team really love to test on, and they have done extensive tests on the SPY with the strangle. And as you can see as well, it is net profitable over the long term. And next is the Iron Condor. As you can see over here, they tested the 20 Delta, $10 white Iron Condor, and they tested it across two different management style. You have one whereby once you put on the trade, you exit at 21 days to expiration. That means there's 21 days left to the expiration of the option. You exit the trade, you put it on again. And the one at the bottom down here is basically just to leave the trade all the way to expiration. And once it expires, you put on another trade again. And in the long term, both are profitable, as you can see. However, if you were to hold all the way to expiration, you kind of have, not too good of a result from 2011 all the way to 2017 and slightly past that. So you definitely want to take note of this, especially if you're trading the Iron Condor. But again, in the long term, it will still have the edge. And finally, we have the Jade Lizard. So Jade Lizard is a pretty fancy name, but all it is just a combination of two strategies. You have the short put and you have the bear call spread. When you combine them together, this is what's called the Jade Lizard. And as you can see over here, regardless if you manage it at 21 DTE or you hold to expiration, it's still going to be net profitable over the long term. So this is actually a very important reason why we want to trade SPY, because the strategies have already been proven profitable on SPY. So what option strategies can you trade on SPY? So I've already shown you in the previous slide those strategies that you can trade on SPY. So basically, you can trade the short put. So short put is the undefined risk strategy. Now, if you don't have enough capital or you don't have that big of an account to put on the short put, then you can put on the bull put spread. So basically, it's the put credit spread. So this way, when you have this long put on, you have already defined your risk to the downside, whereby even if the market, really crashes past this long put, you don't really have to worry because you've already defined your max risk. So you cannot lose more than the risk you've assigned to this put spread. Now, next, you have the strangle, as you have seen just now. Like I mentioned, Tasty Trade really love the strangle strategy. And again, if you're not able to put on the strangle on the SPY, then you can go for the defined risk version, which is the Iron Condor. So basically, the Iron Condor and the strangle, they aim to capture the profits inside the strikes, right? As you can see over here, there is this big gap inside here. So as long as the market pretty much stay within those short strikes, you can be profitable. Next, you have the Jade Lizard. So like I mentioned again, Jade Lizard, very simple strategy. If you think about it, just a combination of two credit strategies. You have the short put plus the bear call spread, and this gives you the Jade Lizard. So the way that the Jade Lizard is constructed is whereby even if the market actually goes past the call spread, you should still be profitable. How does this work? So for example, if your call spread down here is about $2 wide, then the overall credit, right, that you get for this Jade Lizard should be more than $2. So let's say if you get $3, let's say for example, you get $3 in terms of the credit in total, then if the market actually goes past the call spread, you'll be losing the $2 on the call spread, but you still have a spillover of $1, right? So this is how the Jade Lizard is constructed. So it actually has a pretty high win rate. Now, if you're not able to put on the Jade Lizard, which is the undefined risk version, Then you can put on the defined risk version, which I call it the Jade Iron Condor. So now this name is not something that you can find anywhere. In fact, it's not an official name. It's a name that I actually came up with, right? Basically, if you think about it, you look at this structure, it looks like an iron condor, right? You have a put spread at the bottom, you have the call spread at the top, and I just call it Jade because the way that the Jade lizard is designed is very similar to how the Jade Iron Condor is constructed as well, whereby there is supposed to be no risk to the upside. So again, the whole idea here is whereby the total credit they receive for this Jade Iron Condor has to be more than the call spread width over here. Number two, the next stock to trade is XSP. And again, technically not a stock, it's a basket of stocks. So XSP, if you're not familiar with what this is basically the cash settled version of SPY. So in another sense, it can be considered mini SPX. So you may have heard of SPX before. SPX is actually a much bigger product. XSP is the smaller product. So if you're new to trading options and you don't have that big of an account size, then I would strongly suggest that you do not start off with the SPX because the risk is going to be a bit higher down there. Okay, so XSP, why XSP? So the same reasons as SPY, right? Because XSP basically is the same as SPY. Only difference is that this is cash settled index option. So there's the added benefit that it's cash settled. And by cash settled, it just means that there is no assignment of shares whatsoever. So for example, if you take a look at this screenshot over here, you can see that upon exercise or assignment, there's no delivery of shares. So you don't even have to worry about getting shares because if you were to trade on SPY and you get assigned shares and you don't have the capital for that, it's going to get a little bit messy, right? You're going to have margin call, so on and so forth, and you need to kind of unwind it. But with the cash settled index option like the XSP, you don't have this issue. And you do not have early assignment as well, which means to say you can hold all the way to expiration. So that is one of the reasons why cash settled index options are actually pretty popular with a lot of traders. Next, possible favorable tax treatment for people in the US. So this is taken from the CBOE website, as you can see over here under this row that says tax treatment. If you were to trade the CBOE index options, then capital gains may benefit from the 60%/40% tax treatment. But if you were to trade the ETF options, as you can see over here, it says standard, short, and long-term tax rules apply. So you definitely want to find out more about this. If this applies to you, just head on over to the CBOE website for more details on this. Okay, so what option strategy should we trade on XSP? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Well, basically it's the same as SPY. In fact, you can hold all the way to expiration on the strategies that I've mentioned before. So for example, if you want to trade the Iron Condor, you want to hold all the way to expiration, you can do that on XSP rather than at SPY because you don't have to worry about assignment of shares even though your strikes are in the money. And additionally, you can trade the put ratio spread as well. And I must tell you, I love trading the put ratio spread. So the put ratio spread, if you're not familiar, I've already created a number of videos on my channel. Just go to my channel and search for put ratio spread. You should see a number of videos that show up. So as you can see over here, the put ratio spread, this is the structure. You have 2 short puts and then you have 1 long put. Now, this is very important to actually trade it on the XSP rather than SPY. And the reason is because the put ratio spread is actually a very slow spread. So what do I mean by a slow spread? So as you can see over here on the right hand side, I have the P&L graph of the put ratio spread. You can see the line in green, which is this one down here. This is how your P&L would look like at expiration. But the purple line down here, this reflects your P&L for the current day. So once you put it on, you'll see that even though, right, this is where the current market is, even though the market actually goes into your tent, as I would like to call it, you're actually still not in a profit just yet because you need to take a look at the purple line. Purple line just shows you the current P&L for the day itself. And over time, this purple line will start to gravitate upwards to become this green line. But the problem with the put ratio spread is that it takes a very long time before it becomes this green line. And most of the time, based on what I've seen, my experience is that it will get very close to the expiration day. In fact, the last few days, close to expiration, then you will see this purple line actually goes very close to the green line. So when you actually trade the put ratio spread on XSP, you can hold it all the way to expiration because you don't have to worry about the assignment of shares. So let me show you what I mean over here. So if you take a look at the tip of this tent down here, the pinnacle of the tent, this is where you have your 2 short puts at. This denotes this 2 short put, and then you have 1 long put down here. Your long put is actually over here, right? So this is where you have your 1 long put. So for you to try and capitalize on this put ratio spread, to try and capture the most profits, you actually want it to be somewhere inside the tent, right? Preferably near where the 2 short puts are. So imagine if the market actually traded very close to where the short put is, close to expiration. So let's say maybe it came down just below the 2 short puts. If you were to trade this on SPY, then chances of you getting the assignment of shares is going to be very high. Then what's going to happen is that you're going to be long 200 shares and it's going to get very messy. So if you were to trade this on XSP instead, you don't have to worry about this because you can just hold all the way to expiration. Now, if you're not able to put on the put ratio spread, then do not worry because you can put on the defined risk version, which is the put broken wing butterfly. And the only difference pretty much is the long put at the bottom of the structure. So as you can see, this is your defensive long put where it caps the max loss. On to stock number 3, and finally, yes, we have an actual individual stock, and that is Alphabet. So the ticker symbol is Google, G-O-O-G-L. So why Google? So one of the very first thing that I look out for in individual stocks is to ensure that at least it is a fundamentally strong stock. So there are actually quite a number of criteria to identify what's a fundamentally strong stock. But one of the things that I like to look at is to see the income statement, right? Basically the revenue and the net income. And what I'm looking out for is that it has to have increasing revenue and net income as well over the past few years. So in this case, over the past 5 years. So as you can see, pretty stable, right? Pretty consistent. So why is this important when you're trading individual stocks? That is because individual stocks can have a risk of it going bankrupt. Remember, these are all companies behind all these tickers down here. So if the company is not doing well, it's not profitable, then the chances of it going to bankruptcy is going to be there. So the last thing you want is to trade a stock and think that, hey, it is very high premium, high volatility, and the next day the company announces that it's going bankrupt. Then everything is going to be gone, right? Unless, of course, you're smart enough to put on a bearish trade on the underlying. But for the most part, if you want to play it safe, then look for a fundamentally strong stock. At least you know that when you trade it, it's still going to be around by the end of the trade. Now, the next reason why Google, because it's still currently below its fair value. So as you can see over here, this is taken by Simply Wall Street, where it just shows you what is the current price and the fair value. And for Google, right, according to Simply Wall Street, you can see that the fair value is much higher than where the current price is, at least as of this recording. So why is this helpful? Now, this is helpful because if you were to trade Google and you know the fair value is above where the current price is, then at least you have some sort of a margin of safety in a sense, whereby if you were to trade any bullish strategies, you kind of have the confidence to know that over the long term, at least it can gravitate towards its fair value. Now, of course, given that, fair value has many different ways to calculate it, the best thing you can do is just to go to all the different sites, try to get an aggregate value of that, and then just see where the fair value is. If the fair value is above where the current price is, then again, at least you kind of put the odds on your side when you're trading the bullish strategy. Rather than if you find a stock where the fair value is way below the current price, then, a little bit of caution there, especially if you want to trade some bullish strategies on that. Now, the next one is that Google has strong technicals. So what I mean by strong technicals? For me, what I want to see is that the company or the underlying stock has been trading for quite a long time, right? As you can see over here, Google has been trading since 2000 plus. So it's quite a number of years. And most importantly, it has to have gone through several market crashes and still made new highs. All right, similar to SPY, as you can see over here, 2008, there was the great financial crisis. Google actually went down. It went down quite a bit, but eventually it recovered. It went up again. Same thing in pandemic 2020. In fact, in 2020, you can't really see that much of a decline because Google actually did well during the pandemic. A lot of the business shift their focus to online. So this is where Google actually did well. But in 2022, right, as you can see over here, that's the bear market. Google came down a bit, but then eventually made new highs again. So again, as you can see over here, Google has the biasness towards the upside. So if you know that it has a bias towards the upside, you know it's a fundamentally good stock, and also it's below its fair value, then you can kind of position your strategies to kind of take advantage of this. So you're putting all the odds in your favor rather than blindly just looking for stocks with huge volatility. Okay, so now what kind of strategy should we be trading on Google? So for Google, you can trade the wheel strategy. So the wheel strategy, a very simple strategy. How it works is that you first sell the cash secured put. That means to say you actually want to get a sign on the underlying. So you wait for the stock to actually go below the cash secured put, and let's say it expires in the money. You're going to get assigned the 100 shares. Then you sell your covered call. So this is the basic premise of the wheel strategy. Pretty simple. Now, I personally trade the income grid wheel strategy. So it's a variation of the wheel strategy. And basically what it just means is that instead of going for one level and put all your money there, you split the risk for that one level into multiple levels. So if you want to find out more on how I trade this, then definitely go and search for this inside my channel. And you will see quite a number of videos going in depth to explain how to actually set this up. Next, you have the short put. So for the short put, which I am talking about here, is not the cash secured put, but rather the short put on margin, which sometimes people, coin it as the naked put. Now, it's not a very nice name, but basically it just means that you do not want to get a sign on the underlying. Now, if you don't have enough capital, you don't have big enough account size to put on the short put, then you can trade the bull put spread. So similar to what I mentioned in the SPY, basically the bull put spread caps your risk to the downside and can actually be very helpful on individual stocks, because individual stocks, as you know, can have news that can really affect the movement of the underlying. There can be very big movements. For example, if there's going to be earnings coming up, well, it could have a very big gap up or down. Or maybe there's some unexpected news. Maybe the product launch didn't do well, and that can create a very huge movement in the underlying. So if you have this long put at the bottom down here, then it's at least going to protect your max loss. And next, you can trade Google with the call lips. So I share this in one of my videos where I call it the 6-figure lip strategies, whereby you're buying a dip in the money, long dated call option. So this is meant to be a stock replacement strategy. So if you are very strong on Google, you think that it's going to appreciate in the long term, then you can consider trading this call lips. And finally, you can trade the diagonal spread or the poor man's cover call. Basically what it is just a long call, and then you sell the cover call above down here. Now on to our fourth stock. So our fourth stock is another tech stock, and that is Amazon. So why Amazon? Well, pretty much the same reasons which I listed for Google. And you will notice this is actually the theme that I have when I pick individual stocks. So they have to be fundamentally strong. So as you can see over here, Amazon, increasing revenue over the past few years, increasing net income as well, except for maybe 2022. But over the long term, it has been doing pretty well. Next, it is also below its fair value. And as you can see over here, the fair value is much greater than where the current price is, at least as of this recording. And finally, strong technicals. In fact, Amazon has even gone through one of the most challenging times for a tech stock, which is in the year 2000. So this is where the dot-com bubble actually happened. And a lot of tech stocks, all these internet stocks back then, a lot of them actually went bankrupt, out of business. But Amazon not only did it survive, but actually went up to make new highs over time. So what option strategies to trade on Amazon? So same thing, similar to Google, you can trade the wheel strategy. So wait until the market comes down, let you get a sign on the 100 shares, and then you sell the cover call. Now, if you have a little bit more capital, then you can trade the income grid wheel strategy. In fact, I have documented my usage of the income grid wheel strategy on Amazon on my channel. So you can head on over to my channel, just type for the income grid wheel strategy again. You will see a number of videos. One of them, I share my case study where I actually show you how I plot this out or plan out the levels for the income grid wheel strategy on Amazon. Next, you have the short put, similar to the Google as well. And if you don't have the capital for that, a small account size, you can trade the bull put spread. And same thing, if you believe in Amazon, you can trade call lips as a stock replacement, and you can also trade the diagonal spread or the poor man's cover call. Now, we have finally come to the fifth and final stock, and that is United Health Group. The ticker symbol is UNH. So this is slightly different from the tech stocks which I've just shown you in number 3 and number 4. This is actually a healthcare stock. So for UNH, I actually don't trade it as often as some of the underlying that I've shown on this video so far. But when I've traded it, I've actually done pretty well on it. So why UNH? So first off, same thing as well. Fundamentally strong stock, as you can see over here, increasing revenue, increasing net income as well. Next, it's also currently below its fair value. As you can see over here, the fair value given by Simply Wall Street is $1,316. And as you can see, based on the current price, at least as of this recording, it's significantly undervalued. Now, of course, if you find this fair value a little bit way too high, a little bit too ridiculous, again, you can discount the value, right? So maybe if you want to take a more conservative value, maybe put it at $1,000 or $750 or something like that, and you see that the current price is still below that, then at least you know that you still have put, more odds in your favor. Next, UNH, strong technicals as well. As you can see, UNH have traded for many years as well, all the way dated back to around 1990s. And over all the different market crashes, the market eventually made new highs. So all these are the same as Amazon and Google, but there is one added reason why we want to trade UNH, and is that UNH can actually be considered a recession-proof stock. At least that is what the consensus says it is, because generally when the market is in recession or the world is in recession, you still need to go and see the doctor, right? If you're sick, you still need to go and see the doctor. And at the same time, it's not so highly correlated to the market. So for example, you can see over here, this chart down here I've shown is of 2022. So as you know, in 2022, it was a bear market. Most of the stocks actually went down. Some of them really went very far down. But if you take a look at UNH over here, it actually progressively went up and down, and actually pretty much went a little bit higher than where it started off. So in a sense, it kind of provides a little bit of diversification. So if you were to, let's say, trade SPY, trade Google, and then you trade UNH, and let's say you put bullish positions on all of them, then at least you know that if the market actually goes down, then your UNH is at least not going to be in the same boat as the other two, right? Because you have some slight diversification, not too correlated to the market. Okay, so what option strategy should you trade on UNH? So UNH slightly different from the other underlyings which I've shared so far in this video, and also because UNH is pretty pricey. So as of this recording, it's over $500. And if you were to take a look at the option strike prices, you'll notice that there is only $10 strike intervals. So if there's $10 strike intervals, it can be, pretty costly if you were to trade some of those credit strategies. So instead of putting on the credit strategies, for this UNH, I actually trade debit strategies. And also another reason is because the volatility is not that high. So when the volatility is not that high on the underlying, you can actually choose to put on debit strategies. So what debit strategies? Well, the first one is the bull call spread. So the bull call spread, very simple, buy a call option and then sell a further out call option. So this is the bull call spread. And if you were to construct one based on the $10 strike interval, then you can have roughly about $500 risk for that trade. So it's also doable even though you don't have that big of an account. Now, the next and final strategy you can trade on UNH is the diagonal spread, or can be also considered the poor man's cover call if you traded the longer term DTE. So this is actually what I traded on UNH. And in fact, I have actually documented this in one of my videos. So again, if you're interested, just go to my channel and look for poor man's cover call, and you should be able to see my example where I traded UNH on this. Okay, so these are the 5 stocks that have cumulatively generated me pretty decent profits, and I would say it's suitable for you as well, especially if you are new to trading options. So hopefully this video has been helpful for you, and if it has, I would greatly appreciate it if you give me a thumbs up on the video, and also please subscribe for more options trading videos like this, and I will see you in the next video.